Types of risk. Systematic risks are risks that are not diversifiable. For the exam, you'll be expected to be familiar with 3 systematic risks. The first, market risk, is risk that an investment will lose value due to an overall decline in the market. Diversification within the equities market, within the stock market, does not reduce market risk. The S&P, the Standard & Poor's 500 index, is often used to represent the equities market as a whole. So market risk hedges against market risk include buying puts on the S&P 500 or selling short market ETFs like the SPDR.
The second systematic risk that you need to know for the exam is interest rate risk. And that is the risk that a rise in interest rates will reduce the value of existing bond holdings. Remember, interest rates and bond prices move in opposite directions. That means that long-term bonds are most susceptible to interest rate risk. And that's because they are fixed. Long-term bonds are fixed for a longer period of time than shorter-term or medium-term bonds are. And as a result, long-term bonds usually pay a higher coupon than short or medium-term bonds do to compensate investors for the greater interest rate risk. Conversely, long-term bonds also benefit the most from a decline in interest rates, and that's because they have higher coupons, so when interest rates decline, those bonds with higher coupons are worth more and increase in value. Duration, something you need to at least understand superficially for the exam. Duration is a measure of how long it takes to earn back your initial investment in a bond, but it's also a measure of how sensitive a bond is to changes in interest rates, specifically to a 1% change in interest rates. Calculating duration is complex and is determined by maturity date, coupon rate, call features, and credit quality, among other factors. Duration is expressed in years. The higher a bond's duration, the more sensitive it is to interest rate changes. Same for bond funds. So if interest rates rise 1%, then a bond or bond fund with a duration of 5 will decrease in value by 5%. If interest rates decline by 1%, then a bond or bond fund with a duration of 5 will increase in value 5%. Finally, zero coupon bonds, those are bonds that don't pay a coupon, they pay everything, principal and interest, everything back at the end. They have the highest durations because the maturity of a zero coupon is equal to its duration.
Okay, systematic risk number 3, inflation risk, also called purchasing power risk. And that is the risk that inflation will devalue money, will devalue the currency. Fixed income investments, such as bonds or CDs, are at the most risk of inflation. Inflation generally occurs in times of economic expansion, and in economic expansions, in times of inflation, stocks, equities, are a good investment usually during such times because they often beat inflation. In times of a contraction, when deflation may occur, deflation is pretty unusual, but that means prices fall, and the value of a currency rises. But it doesn't need to be deflationary time. It can be just an economic contraction when interest rates are usually going to be dropping. In times of decline, economic decline, fixed income with bonds, CDs, anything with a fixed payment, those are usually a good choice, a good investment choice, because their payments are fixed. So we just learned about the 3 types of systematic risks that you need to know for the exam. Those were market risk, interest rate risk, and inflation risk. And those 3 systematic risks are risks that are generally not diversifiable. You can't invest in other things and diversify those risks out of your portfolio or out of your life, really. That's systematic risks. That's what they were. These now I'm going to talk about unsystematic risks. And unsystematic risks are unique risks, usually associated with a specific investment or asset or category. And with unsystematic risks, unlike systematic risks, diversification helps with this kind of risk because non-systematic or unsystematic risks can be minimized through diversification. Investors do not require compensation or what's called a risk premium for unsystematic risks. So what are some unsystematic risks? That is, risks that are diversifiable. First, business risk. And business risk is the risk that a particular business or industry might face, and every business or industry faces them. They include the risk of obsolescence, the risk of competition, the risk of poor management. Anything that's unique to a specific business would be a business risk. Second, regulatory risk. And regulatory risk describes any risk that might come up because of a change in laws or regulations that would affect the value of an investment. And regulatory risk is pretty significant in the United States, where we have lots of laws. The rule of law is very important, so changes in laws and regulations is common, and so regulatory risk is very real. Diversifying across industries can help with regulatory risk, however. Regulatory risk, let me note, is not the same as political risk. Political risk is the risk, let's change slides. Political risk is the risk that the political situation will change and cause an investment to lose value. And political risk is really not much of a problem in the United States. We have a very stable political situation and stable government. It's much more of a risk overseas, particularly in developing countries. Liquidity risk. Liquidity risk is the risk that an investor won't be able to sell an investment quickly and at a fair price. And all investors really want, or to reduce liquidity risk, you want a market that has lots of buyers and sellers. Thinly traded stocks, private equity, real estate are examples of investments with significant liquidity risk. Opportunity cost, it's categorized with systematic risk or unsystematic risks, but it's slightly different. It's the risk that you could earn something better or different with a different opportunity. It's the cost of a missed opportunity. So for example, if you choose investment A and it returns 5%, but you could have invested in investment B, which returns 8%, your opportunity cost, your lost opportunity, is 3%. Capital structure refers to how a company is financed. That is, where it gets its money and how investors will get paid back. The financing for a company can be from equity, that means stocks or ownership, or debt in the form of bonds or loans, or some combination of both. Financing is usually done to minimize the cost to a business. The financing or capital structure of a business is described on the balance sheet. If a company goes into bankruptcy, the capital structure determines the order of priority. That means who gets paid back first and at what rate. As a rule, debt is considered to be cheaper than equity. That is, debt financing for a business is considered to be cheaper than equity financing because with debt, you're not giving up ownership in the company. But the problem for a small business or a startup business is that debt is much, much harder to get when you're starting out or you're small. Market capitalization measures the equity value in a business, the ownership value of a business. It does not include debt or preferred stock, so market capitalization doesn't give a full picture of a company's capitalization. The formula for market capitalization is shares outstanding times share price. Enterprise value, EV, measures all economic claims on a business, including debt and equity. It is what it might cost if you wanted to buy the entire business. That's enterprise value. It offers a better measure of comparing capitalization among different companies. The only problem is it can be difficult to get all the data. The formula for enterprise value is common equity or market capitalization plus debt plus any minority interest plus preferred equity minus any cash that's in the business. So in the event of a corporate bankruptcy or reorganization, claims get paid generally in the following order, and it's an order you should become familiar with for the exam. There's generally a question on it or two. First, at the top, get paid first, secured claims. Secured claims includes secured bonds. Secured means they're attached to something. They're secured. Then, next, after that, all the unsecured claims. First, at the top of the priority list are any, of course, lawyers' fees, trustee fees, any administrative expenses related to the bankruptcy. Number two, unpaid wages due to employees, and that is up to $10,000 per person. Next, unpaid contributions to employee benefit plans, that's up to $10,000 per person. Customer deposits for personal, family, or household use, up to $1,800. Taxes, unpaid taxes, provided no lien has been filed, are next. And then general unsecured claims, and that includes debentures, debentures are unsecured corporate bonds. First, senior unsecured debt, and then next, subordinated unsecured debt. And the word subordinated just means below. Number three, convertible bonds. Number four, near the bottom but not quite, preferred shareholders. And at the very bottom, the very last on the order of priority of claims and liquidation, the owners of the company, common shareholders, get paid last. Risk questions. Number one, for an investor concerned about interest rate risk, that is the risk of interest rates rising, what type of bond would be the safest bet? Short term, medium term, or long term? So worried about rising interest rates. And the correct answer is short term. And interest rate risk, as I just said, is the risk that interest rates might go up and existing bonds will lose value if that happens. So the longer the maturity, the greater the interest rate risk. Money in short-term bonds is locked up for less time than money in long-term bonds. So an investor would be better off investing, an investor worried about interest rate risk, investing in short-term bonds. Question 2. Which financial statement indicates a company's source of financing, its capital structure? Balance sheet, profit and loss, also known as income statement, cash flow statement, or tax return. So which financial statement shows a company's source of financing, also known as its capital structure? And a company's capital structure is recorded on the balance sheet. And there you can find the debt, the equity. Those are the two kinds of financing, and they're found on the balance sheet. Number 3, diversification can help with which of the following types of risks? Market, liquidity, interest rate, and inflation, also known as purchasing power risk. So diversification can help with which of the following types of risks?
Diversification helps with so-called unsystematic risks, such as business, regulatory, political, and liquidity. Liquidity risk is the risk that an investment can't be sold quickly and easily for a fair price, a seller's fair price. Systematic risks are risks that diversification really doesn't help with. So market risk, interest rate risk, and inflation risk are considered to be risks that all investments share to some extent. So in this question, the correct answer, the one that diversification can help with, is liquidity risk. The other choices, market, interest rate, and inflation, are all systematic risks and are not really aided by diversification. Question 4. In a corporate bankruptcy or reorganization, which order are the following claims? From first to last: common stock, taxes, unpaid wages, secured bonds, preferred stock. So order these in the order of priority of being paid. The correct order of these choices: first would be secured bonds at the top. They would get paid first. Next would be unpaid wages to employees, up to $10,000 per individual. Next would be unpaid taxes. Next would be preferred stock. And last but not least are the owner's common stockholders.